So we'll talk about bid and ask prices, liquidity, and market and limit orders. So the actual trading takes place on a trading board or a trading floor. And for each security, traders can enter their bid prices or the ask prices. Bid is the price at which traders are willing to buy. So if you want to buy and you want to wait, you enter a bid price. Each bid price would have a corresponding number of shares that the traders are willing to buy at their bid price. For each security, traders can also enter an ask price. An ask price is the price at which traders are willing to sell. And each ask price is supposed to have a number of shares that corresponds to it. So let's take a look at a couple of examples. This is Apple, and it's actually trading day and trading time right now, so it's a live price. You see the bid price right here, and then the ask price right here. The bid price is 185.34 and 1,000 shares that are available, and the ask price is 185.39 and 900 shares are available. So some trader or traders are willing to buy at this price this many shares, and some traders are willing to sell at this price this many shares. So if you look at, for instance, detailed data, this data is something that you would have to pay to get, provided by many different sources, in this case, NASDAQ. And I just pulled up an example from their web page. You see the buy orders right here and the sell orders right here. So these are the bid prices and these are the ask prices right here. And notice how you have number of shares coming from a specific exchange or specific source, and then you have the bid price, 576.42. And the current price is 576.53. Now notice this is 300 shares. The second bid price is for 75 shares at 576.40, a little bit cheaper. The third one is 500 shares at 576.40. The fourth one is 10 shares, 576.37, and all the way down to 576.05. And there are 4,512 more bid prices that didn't make up to this board. Now, if you wanted to buy, then you could enter a bid price and you could just wait your turn to be on this list. Now, if you want to go on top of the list, you could have entered a bid price for however many shares that you're going to buy and enter a price that's greater than this. So for instance, 576.50, 45, or 43 even, and you go on top of this list. And you'll wait for somebody to sell it to you at that price. Now, the ask price is the price that you are willing to sell, or traders are willing to sell. So this trader right here, willing to sell 80 shares at 576.52. This 100 shares at 58. So if you wanted to sell, you could actually write down your price, and then notice how these prices are going up. So it's more and more expensive, and there are 3,357 more available. Now, if you wanted to sell and you simply want to wait, you could just put in any price you like and then just wait your turn. If you want to sell at a competitive price and you want to be on top of the list, then you write a price 576 point something smaller than this. So say 50 or 48. Just be more competitive and you'll be on top of the list. The list is very active and it is live. I mean, this is an example of a static page. However, this is going to be, during the day, this is going to be extremely fast, and it will be moving second by second and sometimes nanoseconds, the high-speed trading. So being on top of this list is not all that easy, but it's quite possible. Now, a market order to buy would buy the best ask price available to you. So the market order will buy the best price that's available to you. A market order to sell will sell the best price, will sell at the best price available to you. Now, a limit order will simply place your order at the board. So if you are placing a limit order to buy, you'll be having your place on the bid side and you'll wait. If you are placing a limit order to sell, you'll place your trade right here and you'll wait. But if you're placing a market order to sell, then you'll be selling at the bid price, the best available one. If you're placing a market order to buy, then you'll be buying at the best price available to you, and these prices will change. So while you're placing a market order, you should be very careful, because you may intend to buy at, or you may think that you're going to buy at 576.52, but you may end up buying it at 576.90 simply because the market has changed. So I usually go with the limit order. I don't prefer the market order, simply because you never know what price you're going to end up with. With a limit order, you could enter a very competitive price, even higher than the ask, but at least you know what price you're going to be getting. Now, the amount of which, or amount of trades that you have here, or the traders you know who are willing to buy and who are willing to sell, is referred to as market depth. It is the depth of the market. A shallow market will have few trades and few shares, and a deep market will have as many shares as it can be considered healthy. So the issue here is, for instance, you want to sell, say, 500 shares. If it is a healthy market and deep, that it has depth, then you'll sell your first 300 at this price, remainder 75 at this price, and then the remainder 125 at this price. If you're going to buy 10,000 shares, for instance, then you're going to clear the board. Now, if it is a shallow stock, then there may not be 10,000 shares who are willing to buy, and therefore you may need to wait. Notice, if you buy a chunk, or if you sell a chunk, you're going to clear the board, and the prices will move up, meaning that the bid price will be lower and lower because somebody actually sold a big chunk. And then if you buy a big chunk, then the prices will be higher and higher because somebody has cleared the board and purchased a significant number of shares and shifted the board up. So if you wanted to buy, you can enter a bid price and wait to buy, and that's considered a limit order. You can buy at the best selling price available, and that's a market order. If you wanted to sell, you can enter an ask price and wait to sell, and that will be considered a limit order. You can sell at the best buying price available, and that will be the market order. Now, liquidity, you buy at the best selling price, and then you sell at the best buying price. The difference between the ask and the bid is your cost of liquidity. Well, liquidity is how fast you can turn your asset into cash and how costless. So a very liquid asset will have very small difference. So for instance, bid and ask for Apple right here is 5 cents, 185.34, 185.39. So the difference is 5 cents. I would consider that to be very liquid asset. Not every asset is like this, and you're going to have significant variations in this liquidity. Lower the bid and ask spread, higher the liquidity. Higher the bid and ask spread, lower the liquidity. Meaning, if it costs you too much money to buy and then to sell, then it's going to cost you significant liquidity costs. So let's take a look. I've been talking about this ELD in other videos. This is the Emerging Markets Local Debt Fund ETF. Notice the bid price is $33.55 and the ask price is $33.89. So that's a 39 cents of a spread. That's a very low liquidity. Remember, on Apple at $185 stock, we had a 5 cents of liquidity cost. On a $33 ETF, we have a 34 cents of a liquidity cost. That makes this ELD very, very illiquid. And that's it. Thank you.